Inevitably, there will be individuals who wrongfully profit off of the $2 trillion bailout. As journalist Matt Taibbi writes, the headline-grabbing frauds will be found in the Main Street side, where crooks will scheme to get their hands on $377 billion in relief intended for desperate restaurants, hardware stores, nail salons, and other real-world employers.
But in that piece, Matt argues that the lack of real structural change tied to that legislation has doomed us to repeat all the mistakes of the 2008 crisis and set us up for yet another financial catastrophe. And Matt joins us now via Skype to elaborate. And by the way, Matt, now fully independent. Congratulations.
Congrats.
Just give us a little bit of an update. Let folks know what you're up to and where they can find you.
Yeah, I'm still at Rolling Stone to do print features, and we're still going to have the Useful Idiots podcast, which you've both been on with Katie Halper. But my full-time job is now going to be working for myself, sort of in the fashion of like I.F. Stone doing a regular newsletter, but over the internet through a site called Substack, which is exciting and fun. I'm trying to prove basically that the independent model is going to work better for journalists like me.
That's awesome.
That's what we want. Where can they find you, Matt? How can they all subscribe?
Taibbi.substack.com, but you can just look for my articles anywhere on Twitter at mtaibbi, and you'll see how to get to the articles and subscribe from there.
Yeah, don't tell them they can get it off Twitter. They need to go to the Substack, and they need to subscribe.
They need to subscribe.
They got to prove that this model works.
Please subscribe to Matt's newsletter. Okay, now that all the promotion out of the way. Yeah.
So tell us, I mean, we haven't had you on, actually, since this massive stimulus/corporate bailout bill passed. So just give us sort of your overall thoughts about it.
Well, I think there are specific and longer term problems with this bailout package. The specific issue is that there's basically no oversight, and there's obviously a Main Street portion of this bill which is different from the last 2008-2009 rescue, where there almost none of it went to actual people. But the execution of it is going to be extremely complicated. They're doing it through the Small Business Association, which is totally overwhelmed and not equal to the task of administering that many loans. And so, I talked to the former bailout inspector who said you can expect tens of billions of loss to fraud just on that side of the bailout. But the larger problem is on the financial side, where we've just sort of accepted the idea that maintaining prices in the financial markets as an end in itself. And so we're throwing trillions of dollars at this with literally no oversight. And this is a repeat of 2008. And what people forget is in the intervening period, all this new money that the last bailout injected into the system has been devoured by stock buybacks by all these companies. So we're essentially just bailing out 12 years of profit hoarding by all these companies. That's why they don't have any money. Not only did they take it all, they borrowed more money to commit more of it to stock buybacks, and that's why they essentially need a bailout now.
Right, and Matt, I mean, this really could cause financial contagion in the system, and the fact that we haven't learned our lesson the second time around is troubling. Let's lay out the political and societal implications for that. You've covered this now for a long time. What were the societal impacts of the 2008 bailout, culminating in Occupy Wall Street? Now they've done it a second time around. In modern memory and in recent people's lifetimes, what is that going to do to the political moment?
Well, last time around, again, so last time around it was especially bad because we directly bailed out the people who were criminally responsible for causing the crash. So, we had all these people who took dangerously irresponsible bets in the mortgage markets on products they knew were going to explode, and that we bailed them all out. We just threw a whole bunch of money at them. We created all these Fed facilities that were designed to offlift all the bad investments that these companies made onto the Fed. And all that did is incentivize these companies to engage in similarly risky behavior. They just did it in a different market the next time. This time around, it was in commercial loans and corporate takeovers. It wasn't in mortgages so much, and that's what we're bailing out now. So it's going to be a sort of an endless cycle of this kind of activity.
What do you make of the way that Democrats approached all of this? Because you remember they made a big show of basically killing this bill twice because it had this massive corporate slush fund with no oversight. Chuck Schumer tells us, we fought hard and got this oversight, this inspector general. Then, of course, President Trump immediately upon signing is like, yeah, that's nice. Then he fires the inspector general. So obviously, and look, it was clear in the bill. It was always in his hands to be able to do that. So it was clear as day that the oversight was always toothless from the beginning. But what do you make of, Democrats? Do you think they got rolled? Do you think that they were actively sort of complicit? They were happy to have this corporate slush fund with no oversight. Is oversight even really the thing that we need, or should we have been fighting on the grounds of whether this amount of money should go to a corporate bailout in the first place?
Well, if you remember the last bailout, there actually were significant numbers of both Republicans and Democrats who didn't vote for the TARP. And there was significant opposition both times they had to vote for the two big pieces of the bailout package. This time, this passed 96-0 in the Senate, and it was done on a voice vote in the House. So yes, they made a show of opposing it, but it was, in the end, they just really rolled over for everything. And all they did really was ask to tweak the ratios of how much money would go where. And there was really no sophisticated opposition to any of the bigger portions of the bill, which are all about propping up the financial markets. They created essentially a gigantic government-run hedge fund that is going to permanently be pumping liquidity into a whole range now of financial markets. They created a new one yesterday for high-yield corporate debt. I mean, essentially the government's going to be buying junk bonds now. This is it's insanity, and I talk to people in the business who are basically saying, we didn't even ask for this stuff, and they're giving it to us. And
Wow.
I think the Democrats, again, it's a repeat of the last time, where a lot of the members in Congress just don't understand what it is that they're doing. So that's part of the problem.
And Matt, we're seeing this reflected in the financial markets. Matt, friend of the show, Matt Stoller, actually tracks this very well. It's like immediately after this happens, he goes and he looks at the listed funds of like private equity, mortgage debt, and it's like all of it starts to spike. He sees that, the markets reacted very favorably. We saw CNBC cheering on the Federal Reserve. I think it's very important to understand the implications of what you're saying, which is that there are huge debt pools and liquidity, cash available to big business, to the financial markets, while people cannot pay their rent. We know that, according to the Wall Street Journal, 1/3 of people were not able to make their rent in April. So that is only going to go up, as 16.6 million unemployment claims have now been filed in 3 weeks. Lay that out for people, just that stark difference of who is getting money and who is not.
Well, if you want to apply for a loan in the quote unquote Main Street portion of the bill, you have to go through a whole series of steps. There's all these obstacles. You got to go through the SBA. You got to go to your local bank. The bank has to go through an extremely complicated application process. There's all these different restrictions and conditions that it's a kind of means testing that you have to go through to get the money. Meanwhile, on the financial side, even before the CARES Act was passed, the Fed was announcing, oh yeah, we're going to start buying $75 billion of mortgage-backed securities a day, or $50 billion in treasuries a day. And that was just an appetizer for the size of the other programs. They have a whole series of Fed facilities that are instantaneously going to go to propping up all these bad investments, and so you have BlackRock, which is the world's largest asset manager, now is in charge of administering the very kinds of products that they trade in on a day-to-day basis. So all these companies are going to be rescued and propped up, in a split second. And forever, as opposed to the ordinary person who's going to have to wait in line for something that is just going to be a loan for most people.
Right.
I think that's what. Yeah. So I think that's going to be the difference.
Mm-hmm. And the thing that you're pointing out here is this just isn't a matter of fairness, like, oh, it's unfair that they're getting more than this. This is a matter of fundamentally shifting the structure of the economy in a way that is very much a replay of 2008, where those who were already big just got bigger. Those who were already rich just got richer, and everybody else got squeezed. Small businesses continued to go under. Small banks, community banks, continue to get gobbled up by the big guys. And we're sort of laying out the groundwork for another round of consolidation, which hands monopoly-type powers to these large corporations to occur once again.
Yeah, and the impact of the last bailouts was we took a system that was too big to fail, that was hyper concentrated. We made it more concentrated. The companies that did fail, we folded them into bigger companies to make them more systemically dangerous. We encouraged companies that made bad investments to continue making bad investments, because we used the Fed basically as a garbage mechanism to pull all these bad investments off their books, to make them whole again, to make them allow them to continue doing bonuses. I mean, a lot of those companies were doing stock buybacks right up until the moment of the meltdown in September 2008, and continued doing them right after they got the bailouts. So they never stopped essentially looting their own companies, and they were never punished for it, which totally incentivized them to do it all over again. And that's exactly what happened. We saw record, multi-trillion dollar, in the last 2 or 3 years, we saw over $1 trillion a year go to stock buybacks. So all that money is disappearing from the economy, and we're just going to reliquidate it again, allow them to do it again, and this cycle is going to continue. Meanwhile, as you point out, on the other end, you see more and more stress on ordinary people who are having a harder and harder time getting their money, and it's an unfairness machine. It's an inequality machine.
Well, Matt, thank you so much for reporting on this, an essential voice in these times. Again, everybody, please go subscribe to Matt's Substack. He's an amazing journalist doing amazing work. Thank you, Matt.
Thank you, Matt.
Thanks so much, Crystal Sager. Take care.
Next on Rising, House Democrats plan to draft another round of massive coronavirus relief legislation with focus on job creation. Hill reporter Mike Lewis, he joins us now to discuss when Rising continues.